Welcome, ladies and gentlemen, to our discussion of Hal Scott's sobering new book, Connectedness and Contagion. Here it is. And if you didn't notice, we have copies for sale out in the hall. It's my pleasure to remind you that you're welcome to buy a copy and that Hal will be available to autograph them during the reception, which will follow immediately after the panel. I'm Alex Pollock of the R Street Institute, and here we are in AEI's stylish new conference center to discuss a very old problem, namely how best to survive financial panics, of which there have been many across the centuries, how to survive the contagion of fear and distrust when financial actors try to withdraw from risk to protect themselves, a rational strategy for each, but, as we all know, not when they all do it at the same time. This is highly interesting historically, but much more pressing when we consider, as Hal's book does in scholarly detail, what we'll be able to do in the next panic, which assuredly will arrive sooner or later. 2 centuries ago, David Ricardo accurately observed, quote, "On extraordinary occasions, a general panic may seize the country when everyone becomes desirous of possessing himself of the precious metals," today that's of treasury bills or equivalent. Against such panic, Ricardo concludes banks have no security on any system, that is to say the private banks on their own. Walter Bagehot, commenting on this statement in 1873, draws the conclusion we all know was true then and is still true now, to wit, if all the creditors demand their money at once, they can't have it. Moreover, Bagehot goes on, when apprehension passes a certain bound, no private banker is safe. For, as Bagehot also says, every banker knows that if he has to prove he is worthy of credit, however good may be his arguments, in fact, his credit is gone. And that's what happens in the panic. Everybody's credit is gone because nobody can prove he's worthy of credit, and they're not even sure about their own solvency. Well, what do you do then? Then you have to finance the bust. So the central bank and the government's treasury provide new debt, and as Hal says, also new equity, expanding their own balance sheets so everybody else's balance sheet can shrink, expanding their own risk so everybody else's risk can go down. And that's what you have to do if you want to avoid driving asset prices into a wild downside overshoot. Hal's book discusses how this survival process has been made much harder by the post-crisis legislation in the US, notably the Dodd-Frank Act. And he, interestingly, points out how this is notably different from other countries. So, for example, he says, the United States is rather unique in its apparent resolve, however unrealistic it may be, to forswear any use of bailouts in the future. Hal predicts there will be bailouts in the future, but that they'll be a lot more cumbersome, slower, and harder to do. And he predicts that in time, we will greatly regret the changes which have been made if they're not corrected before the inevitable next crisis, and that those changes will make in the next time things a lot worse. Hal is going to present his book, which he'll do for about 25 minutes. Then we'll have comments from our outstanding panel, whom I'll introduce at that point. Our author, Hal Scott, is the Nomura Professor and Director of the Program on International Financial Systems at the Harvard Law School, where he's taught since 1975. He's also Director of the Committee on Capital Markets Regulation, an independent director of Lazard Limited, a member of the Bretton Woods Committee and the Market Monitoring Group of the Institute of International Finance, and a past president of the International Academy of Consumer and Commercial Law. His books include International Finance, Transactions, Policy, and Regulation, which has gone to 20 editions, I see. 21. And The Global Financial Crisis. That means the last crisis. Tonight, in presenting Connectedness and Contagion, he will address how to be better prepared for the next crisis. Hal, welcome to the AEI podium.
Thank you, Alex, for a clearer presentation of my book than I was able to make in many more pages. And thank you to AEI for hosting this event. So the thesis of my book is that the heart of the 2008 crisis and most other financial crises was systemic risk in the form of contagion. That this crisis was successfully stemmed with three weapons: lender of last resort, liability guarantees, and capital injections. Post-crisis, all of these weapons were eliminated primarily by Dodd-Frank as undesirable bailouts. Dodd-Frank purports to solve the contagion problem with what I call two wings and a prayer. The wings are heightened capital and new liquidity requirements, and the prayer is new resolution procedures. But you don't abolish the fire department even if you believe you have more fire-resistant buildings. That's basically what the attitude has been post-crisis. Thus, we need to restore and indeed strengthen the three powers we weakened or took away. But, bad news, the likelihood of doing so in the anti-bailout consensus that exists today is very low, so we are dangerously exposed to future crises. That's the thesis of the book. So let me talk about the elements of systemic risk. The main point of the financial system regulation is to prevent systemic risk, of which there are three varieties, what I call the three C's: correlation, connectedness, and contagion. Correlation refers to the situation where the same external event creates losses for a large number of important financial institutions, like a housing price collapse. That was part of 2008, but it's not the focus of my book. Connectedness comes in two flavors: asset connectedness, where the losses of one financial institution causes losses of other financial institutions, which sets off a chain reaction of failure. Or liability connectedness, where the failure of one financial institution endangers the funding of other financial institutions, largely the focus of network theory. For example, if a bank settling tri-party repos were to fail, that would create a problem. The third C is contagion, where the actual failure or fear of failure of a financial institution causes short-term creditor investors to withdraw and withhold funding for financial institutions, either out of a lack of information or irrational panic or some combination of the two. So the first part of the book looks at whether the problem in 2008 was contagion or connectedness. Contagion, in my view, was the primary driver of the 2008 financial crisis. Basically, asset connectedness was not the primary driver of the 2008 financial crisis, neither form of connectedness. Leading up to Lehman's fall, major banks saw some deposit runs, including National City, Wachovia, IndyMac, and Washington Mutual. But the Lehman Brothers insolvency filing in 2008 put contagion in overdrive as short-term creditors headed for the exits, fearful that the institutions to which they extended credit might meet the same fate as Lehman. Lehman's failure triggered a major run on U.S. money market funds, starting with the Reserve Primary Fund, which broke the buck on September 16, 2008, owing mainly to massive investor redemptions due to losses from the fund's significant direct exposure to Lehman, an example of connectedness. The run spread quickly across the money market fund industry, however, including institutions with no significant exposure to Lehman. Contagion also spread to short-term asset-backed commercial paper markets as money market funds shifted their holding to risk-free U.S. government securities. In the interbank lending market, the London interbank offered rate, LIBOR, rose sharply, and many banks discontinued lending entirely on the interbank market. Repo markets also froze up. That's what happened. Now, many people believe that asset connectedness was the major problem during the crisis. The book examines this claim in detail. While investors in the Reserve Primary Fund, which had overly invested in Lehman, lost money, let's remember it was less than a penny on the dollar, and no financial institution connected to Lehman failed as a result of the failure of Lehman. Moreover, no financial institution exposed to AIG would have failed if AIG had failed. For example, Goldman Sachs would have experienced a maximum 18% loss of capital from its CDS collateralized positions with Lehman, less than the conventional 25% loan loss secured lending limits for banks. And this does not even take account of the CDSs Goldman had on AIG, which further protected Goldman from loss. Nonetheless, the scenario coming out of the crisis was there was a connectedness problem. And Dodd-Frank reforms largely focused on this. SIFI designation by FSOC is largely built around connectedness. Look at the terms of designation, a lot of connectedness. As a central clearing for over-the-counter derivatives, the idea is we have to mutualize the losses, we'll have a chain reaction of failure, and certainly bilateral exposure limits. These were all parts of Dodd-Frank. Now, while one can argue that these reforms are desirable as preventive measures generally, apart from the experience in 2008, connectedness was not the problem in 2008. So Dodd-Frank also did something else, which was to legislate with respect to contagion. As I said at the outset, 3 measures were deployed during the crisis to stop the contagious runs on banks and non-banks: lender of last resort, liability guarantees, and capital injections into banks. Lender of last resort. The Fed was created in 1913 to stop financial panics, the latest of which was in 1907. Interestingly, that panic in 1907 started in the non-bank sector at the Knickerbocker Trust Company. During the 2008 crisis, the Fed amply discharged its lender of last resort responsibility through a variety of means: lower penalty rate at the discount window, wider access for primary dealers to the window, and a term auction facility were major changes. And a number of new facilities were created for non-banks. I can't go into all of them here, but they included the commercial paper funding facility to purchase unsecured and ABCP paper from corporate issuers, and the money market investor funding facility to purchase assets from money market funds to provide them with liquidity. The supply of this liquidity to the financial sector doubled the Fed's balance sheet to $2 trillion by 2009. In 2007, before these actions, 91% of its balance sheet was invested in US Treasuries. By 2009, it was only 25% due to this lending expansion. Supplying liquidity to the non-bank system was very important. It provided non-banks with almost $1 trillion in loans and general market liquidity. More importantly, the very availability of these facilities helped stop the run. The Fed, and in turn the taxpayer, actually benefited from this new lending. Balance sheet expansion generates more profits. The Fed pays not much on the liabilities, bank reserves, interest on reserves, which actually didn't exist until the crisis, and currency, and makes money on the assets. And the Fed profits are remitted to the Treasury to support general revenue. In 2008, these remittances had risen to $40 billion. As I said, a key part of the Fed lending was to non-banks, where the contagious run was largely centered after the 2008 failure of Lehman. I estimate that today there is about $7 trillion in uninsured short-term funding in the U.S. financial system, with 60% of this in non-banks, primarily money market funds and broker-dealers. The ability to lend to non-banks in a crisis is essential, and I would expect this percentage to increase as lending and capital market activities are increasingly driven out of the overregulated banking system. The legal authority for this lending to non-banks was the then quite broad Section 13.3 of the Federal Reserve Act. It provided that, quote, in unusual and exigent circumstances, the board could authorize a reserve bank to make loans to, quote, any individual, partnership, or corporation, end of quote, where such loans were, quote, secured to the satisfaction of the Federal Reserve Bank, unquote. This authority to loan to non-banks, by the way, is quite separate from the discount window authority under Sections 10b and 13.2 of the Federal Reserve Act to lend to depository institutions like banks. Now, while use of this broad authority to lend to non-banks was crucial in stopping the contagious run, after the fact, it was and continues to be widely attacked as bailing out Wall Street. This is despite the fact that taxpayers benefited from this lending. Now, legitimate moral hazard concerns have been raised about this lending, but the beneficiaries of the lending were largely victims of a panic. Without panicked withdrawals from these institutions, Alex kind of alluded to this, they would have been solvent. A notable exception was AIG, but in general, totally solvent institutions were beset by these runs, making them insolvent, would have made them insolvent, but for the lending. Now, this anti-bailout concern triggered radical calls for changes in 13.3 lending authority for non-banks. And oddly, such concerns did not translate over to the Fed's use of the discount window, kind of focused on the non-banks. The result was that the Dodd-Frank Act placed significant constraints on the Fed's 13.3 lending authority. What are they? First, the Fed can only now lend to non-banks with the approval of the Secretary of Treasury under procedures adopted in consultation with the Treasury. Interestingly, this requirement for approval was first put forward by the Treasury itself, then headed by Secretary Geithner. Perhaps this was just another chapter in the Fed-Treasury turf war, or maybe Geithner thought this was a way to protect the Fed from even greater restrictions, which indeed were then actively being considered in the Congress. Now, one can argue with the importance of this restriction, though it is clearly taking independent authority away from the Fed. Some point correctly to the fact that Paulson was Bernanke's cheerleader during the crisis. But will all secretaries of Treasury in the new anti-bailout environment be such willing cheerleaders? Treasury approval would now carry a significant political risk. And the markets will know Fed support may not be assured, which itself could accelerate a run. If we think it is important for the Fed to have independence to lend to banks, why not to non-banks, an ever increasing important factor in our financial system? Second, the amendments to 13.3 provide that the Fed can no longer make one-off loans to single beneficiaries, such as it did in 2008 to AIG. It must now do so, according to Dodd-Frank, under a broad program. A Fed regulation implementing this provision provides that at least 5 institutions must be eligible for any Fed program. Now, if this means eligible at the time the Fed provides the first loan, it may make it harder to nip a contagious run in the bud. You got to wait until 5 institutions have a problem. If it means, on the other hand, ever eligible for a loan, then it is not much of a restriction, but under that interpretation, the first loan could trigger cries of inappropriate behavior or even illegality. Third, Dodd-Frank required that all loans must be collateralized. Before, it was just to the satisfaction of the Fed, and a lendable value assigned to all collateral. This reined in the Fed's authority, among other things, to buy unsecured commercial paper, which it did for major non-financial issuers in the crisis, and more generally deprives the Fed of discretion on setting collateral requirements. Fourth, the Fed can only loan to solvent institutions, again, a requirement not applied to banks, just non-banks. Now, while a solvency requirement is a cardinal principle in Bagehot's 19th century formulation of the appropriate role of the lender of last resort, many have pointed out, Charles Goodhart for one, that this has often been honored only in the breach, here and abroad. Now, one reason for not requiring that the central bank determine that its borrower is solvent is that judging solvency is extremely difficult. Should assets be valued at mark-to-market, a price which might also already reflect fire sale prices? Or should they be valued at what they would be if the Fed lent? An underlying argument for a solvency requirement is that lending to an insolvent institution should be a fiscal issue in which the Congress would play a major role through appropriations, as it did indeed in TARP. And I sort of agree with this point of view. But if you're going to have that point of view, then lender of last resort needs to be coupled with what I would call standing TARP authority, so that there is the possibility that the Treasury can act when the Fed can't. A fifth provision of Dodd-Frank provides for disclosure. All loans to non-banks must be reported within 7 days to the two chairmen of the House and Senate Financial Institution Committees and must then be disclosed to the public within a year. On the banking side, one change on the window, all discount window loans must now be publicly reported within 2 years. Now, the concern with such disclosure requirements, much more stringent, by the way, than those facing any other major central bank, is that the prospect of disclosure, certainly within 7 days, and even within 2 years, may discourage borrowers concerned with stigma from seeking needed support, thus worsening the problem. You want them to get the support. Indeed, in the crisis, banks in need of funding avoided the discount window out of fear that their borrowing might be leaked or uncovered by analysts, thus leading the Fed to create the term auction facility where all banks, whether in trouble or not, could attain cheap funding. Sixth, Dodd-Frank provides that banks can no longer pass on discount window loans to their non-bank affiliates, such as broker-dealers, without being subject to the normal Section 23A limits on inter-affiliate lending, which would be precluding a full pass-on. This means that substantial borrowing by bank-affiliated broker-dealers would have to occur under the new restrictions, 13.3. It couldn't be by the window and then passed on. Indeed, the multiplicity of restraints that are now imposed under Section 13.3, but do not apply to discount window borrowing, which is reserved to depository institutions, prompted New York Fed President Dudley to suggest last May that Congress amend its discount window authority to permit loans to non-banks. However, this is dead on arrival because it would in effect represent a repeal of the Dodd-Frank 13.3 restrictions. Some in the Fed, including Governor Powell and ex-Chairman Bernanke, have said that they can live with these Dodd-Frank restrictions. But they have taken this position, in my view, to stave off further restrictions. On November 15th of last year, the House passed the so-called FORM Act, largely along party lines, 241 to 185, Republicans for, Democrats against. The bill has not been enacted into law, but it's passed the House. Under the FORM Act, the Federal Reserve could only loan to non-banks if at least 9 of the 12 Federal Reserve bank presidents voted in the affirmative. Further, all federal regulators of the potential borrower, which would often include the SEC or even the CFPB, would have to certify that the borrower was not insolvent. Chair Yellen said at the time that these provisions would essentially end Federal Reserve lending to non-banks. This FORM Act has now been incorporated into the House financial reform package. Now, these attacks on the Fed's role of lender of last resort are not recent. My book recounts how opposition to any role for a, quote, federal bank, whether lending to commercial or bank borrowers, goes back to the early controversies in our history over the first and second national banks. Andrew Jackson vetoed the renewal of the charter of the Second National Bank in 1832. It's this debate over federal bank institution that took us so long to create the Fed in 1913, and this debate still goes on. All right, so the second part of the fight against contagion were guarantees. In October of 2008, the FDIC used its authority to remove any limits on deposit insurance for transaction accounts, which are key to the payment system, and increased insurance limits on other accounts from $100,000 to $250,000. While Dodd-Frank permanently increased deposit insurance limits to $250,000, it removed the authority of the FDIC to raise any limits in the future without joint resolution from Congress. In addition, the FDIC established the so-called Temporary Liquidity Guarantee Program in October 2008, which gave depository institutions and their holding companies authority to issue new senior unsecured debt guaranteed by the FDIC. This power was also taken away by Dodd-Frank. And by the way, the FDIC made money on these programs. There were no taxpayer losses. In addition, in 2008, following the breakout of the run on the money market funds, the Treasury used its authority under the Exchange Stabilization Fund to guarantee the money market funds. This had a major impact in stopping the run on the funds. This power was also taken away by Dodd-Frank, and not by Dodd-Frank, actually, by the earlier TARP legislation. And by the way, Treasury made $1.2 billion in fees on this program and never paid out a cent. Now, runs on money market funds remain a problem, in my view, which has not been cured by the SEC's required floating net asset value on prime institutional funds. Even if funds post their true values, investors will still redeem if they expect values to go lower. And SEC rules giving funds the authority to limit or charge for redemptions in adverse conditions may just accelerate runs, as Commissioner Stein observed in her dissent to that reform. The final tool used to combat contagion was TARP. As of June 2016, there had been $204.89 billion of capital injections into banks. And on this injection, Treasury made, not lost, $16.28 billion. So Treasury made money on this program. The taxpayer did not pay for this. TARP expires by its own terms. Thus, unlike the EU or Japan, which have standing authority for capital injections, if the U.S. needs such injections in the future, authority would have to be obtained, might have to be obtained in the midst of the crisis itself, as it was in 2008. Now, while contagion fighting powers have been curtailed, defenders of Dodd-Frank point to what I call two wings and a prayer. The wings being capital and liquidity, the prayer being new resolution procedures. The premise is, since contagion is much less likely, we need not worry much about it anymore. Capital requirements are wing one. We have greatly increased capital requirements, no doubt about it. Now, I put aside the difficult issues about methodology in capital requirements, leverage versus risk weights, static Basel versus stress tests, etc. But let's not fool ourselves. There are major methodological problems in setting capital requirements when they're not done by the market. Now, capital requirements can reduce systemic risk by decreasing the probability of bank failure from any form, and they generally reduce moral hazard. But no realistic level of capital can prevent a run on banks. Due to fire sales, capital is quickly eroded. Even higher capital proposals like Admati and Helwig's suggestion of 20 to 30% leverage ratio would not prevent bank failure in the face of contagion. And, underline this, capital requirements only apply to banks, not to the ever increasingly important non-banks. The second wing was liquidity, okay? After the 2008 crisis, we adopted, again through Basel, certain liquidity requirements, most notably the liquidity coverage ratio, which has a 30-day horizon and requires banks to hold high-quality liquid assets to cover expected funding runoffs. These requirements, in effect, discourage short-term lending. Again, they do not apply to non-banks. As with capital requirements, there are significant methodological issues, largely around runoff assumptions and what counts as high-quality liquid assets. In my view, The new adoption of private liquidity requirements represents a retreat by the Fed from providing public liquidity as lender of last resort. The Fed can now say it will only be a backup source of liquidity. The front line is the bank's liquidity itself. But ironically, the private liquidity requirements may actually reduce collective private liquidity because it requires each bank to hold their own liquidity rather than making it available to others in a crisis. So whether it really comes, to prevent Fed lending is open to question. So 2 minutes. I think I'll make it. So the prayer is resolution procedures. Dodd-Frank's orderly liquidation authority gives the FDIC new powers to resolve non-bank financial firms, including bank holdings companies, whose failure upon a 2/3 vote of the Fed governors and FDIC directors and the Treasury are determined to pose serious adverse effects to the financial stability of the United States. If such a determination is not made, the non-bank financial institutions, including bank holding companies, will continue to be resolved in bankruptcy. Such procedures, in my view, are unlikely to deter contagion. At the outset, without the requisite approvals, this new procedure may never be used. If it is used, the FDIC has designed a single point of entry procedure requiring restructuring at the holding company level, a major consequence of which is that short-term funding at the operating subsidiary level, where almost all short-term funding exists, mainly through banks and their broker-dealer subsidiaries, will be unaffected. Thus, some hope this will stop contagion, since the FDIC resolution will not endanger existing short-term funding. But whether such restructuring will actually work, particularly for a major multinational bank, is problematic, highly problematic, and the procedure has never been tested. Thus, this is a prayer. The reality is that creditors of financial institutions will run if a large financial institution is put into any kind of resolution. Better safe than sorry. And we need to be prepared for that. So resolution procedures are good, but don't think you get rid of contagion fighting just because you have them. It actually works the other way. Easier to resolve an institution if you know you can prevent the contagion that might follow from its resolution. I won't comment, because Alex will be jerking me off of this platform, on kind of other solutions to the problem, like limiting short-term funding, but if we have time to discuss it in the repartee and the Q&A, I'll talk about that. So what are the conclusions? Contagion in the non-bank as well as the bank sector, not connectedness, is the major systemic concern, but Dodd-Frank was focused on connectedness. We know how to stop contagion through the use of lender of last resort, guarantees, and capital injections. But these powers have been greatly weakened by legislation and due to the fear of bailouts won't easily be restored. Third, capital liquidity and resolution will not safe-proof the system from contagion. Even if homes are fireproofed, you still need a fire department. Proposals to limit short-term funding, which I don't have time to go into, also I do not think the answer. So let's just hope we do not have another crisis before we can move beyond the fears of bailing out Wall Street and are able to rectify the situation. Thank you very much.
Thanks, Hal. We have coming up three outstanding discussants who will each speak for about 8 minutes. I'll introduce them all in the order in which they will speak. After they do, we'll give Hal a chance to respond to them, and then the panel to exchange ideas, after which we should have some time for your questions. But we are going to adjourn promptly at 6:15 to our reception. Our first discussant will be Al Broadus, who was president of the Federal Reserve Bank of Richmond from 1993 to 2004, having joined the bank's research staff as an economist in 1970 and become director of research in 1985. As a Federal Reserve President, of course, he served as a member of the Open Market Committee. Al is a member of the board of the Virginia Council on Economic Education, the Advisory Council of the School of Business of the University of Richmond, the Executive Committee of Richmond Renaissance, and numerous other boards. Next will be Pete Kyle, who is the Charles E. Smith Professor of Finance at the University of Maryland's Smith School of Business. Pete's research includes market microstructure, high-frequency trading, informed speculative trading, market manipulation, price volatility, market liquidity, and contagion. He's been a staff member of the Presidential Task Force on Market Mechanisms, a consultant to the Securities and Exchange Commission, the CFTC, and the Department of Justice, and a member of the CFTC's Technology Advisory Committee. Our third discussant will be Paul Kupiec, who is a resident scholar at AEI, who focuses on the management and regulation of financial institutions, financial markets, systemic risk, and the impact of financial regulations on the economy. Previously, Paul was director of the Center for Financial Research at the Federal Deposit Insurance Corporation and chairman of the Research Task Force of the Basel Committee on Banking Supervision, and held positions also at the IMF, Freddie Mac, J.P. Morgan, and the Board of Governors of the Federal Reserve. Paul has also organized this event, so thank you, Paul, for getting us all here. And Al, we'll start with you.
Thank you. Thank you very much, Alex. I hope I didn't scare anybody too badly when I knocked my sign there over. I got punished. I was trying to get to my water, and when I finally did, I couldn't open it. I guess another sign of age.
A typical liquidity problem.
There you go. Only a couple of minutes from now, I'll be able to solve it, I hope. But it's very good to be here. We panelists, as Alex has already mentioned, were instructed pretty firmly in advance to try to hold our remarks to 8 minutes, which made me think, reminded me of Mark Twain's famous dictum that if he had had more time, he would have written a shorter letter. In any case, I will try to meet the requirement, and I know we're running maybe a little bit late here. I believe that Professor Scott's book, Hal's book, is a very good book and a very important book. As you all know well, a number of books have been written from various perspectives about the financial crisis, and several, I would argue, are really essential to appreciating the scope, nature, and significance of the event. I think of Ben Bernanke's recent memoir, Tim Geithner's stress test book, Secretary Paulson's book. They all, I think, help us understand what it was like for policymakers who actually confronted the crisis on the front lines. And I would add to that list Alan Blinder's book, which I think it's the one that has, I think, a phrase like musical chairs somewhere in the title. When I read it, it struck me as an especially lucid review of the broader causes of the crisis and questions as to how effectively it was dealt with as it played itself out. For me, Hal's book is a very valuable and highly useful addition to this literature. It provides an intense and penetrating, we've seen this already in his remarks, an intense and penetrating analysis of the anatomy of the crisis. I almost want to say dissection of the crisis, which then serves as a solid foundation for evaluating the steps that have been taken subsequently, especially in the Dodd-Frank law, to prevent or more realistically mitigate any recurrence. When I say anatomy of the crisis, I have in mind Professor Scott's clear delineation, which he has already reviewed, and which is underlined by the book's title, between what he terms as the connectedness from what he terms contagion as the systemic drivers of the crisis, and his conclusion, as he noted, that contagion was the primary driver, and hence the appropriate focus of efforts to remediate. The book argues convincingly, in my view, that asset and liability connectedness did not play major roles in the core collapses of Lehman Brothers and AIG. Rather, contagion, which is simply today's augmented version of an old-fashioned wonderful life bank run, turned these events into a broad and extremely dangerous crisis. Given this, Scott believes that the Fed, the FDIC, and the Treasury addressed the crisis appropriately, if not always smoothly, and prevented a much worse outcome. With my background at the Fed, which has been reviewed, I acknowledge my bias, but I happen to agree with him. From this premise, Professor Scott proceeds to what I take to be the book's central point, or certainly one of the central points, that many of the sometimes politically charged provisions of the Dodd-Frank law are largely based on the mistaken belief that connectedness was the problem, and that the provisions that restrict the Fed's lender of last resort powers and the Fed's complementary powers risk severely weakening the government's ability to successfully contain a future crisis if one arises. And I have to say that this, history teaches us that that's a very likely occurrence. As we've already heard, Scott analyzes each of these limitations. He does this in Chapter 9, which for me is in many ways the heart of the book. I can't review them all here. Actually, Hal has done a pretty good job already of doing that. But let me just give you an example of one that he's already mentioned, which I think really gives you the flavor. During the crisis, the Fed, as he mentioned, was able to make Section 13(3) loans independently to non-bank financial institutions. Dodd-Frank, as he's pointed out, requires such loans to be approved by the Treasury Secretary. This may be understandable, an understandable provision given the political climate in which the Dodd-Frank law was written. Ben Bernanke himself seems to conclude in a recent blog piece on emergency lending that the requirement is a necessary and workable compromise in a democratic society. And maybe that's right. But what if the Treasury Secretary, who is, after all, a political appointee, at the time of a future crisis, is a highly political figure, not experienced in or well informed about managing financial crises? I dare to suggest that it's not difficult to imagine such a scenario in today's world. A strong perception, indeed absolute confidence among financial market participants that the Fed and the FDIC together can and will act forcefully and immediately to stop a run would be essential to actually doing so. In more typical central banking language, their credibility in this regard would need to be complete and robust. If there were doubts in markets that the Treasury Secretary would go along or that he would delay unduly, markets would be at high risk of running. If you think there's going to be a hit, let someone else, you think there's going to be a hit, let someone else take that hit. I would say that Professor Scott's insistence on the primacy of this reality with respect to the Treasury Secretary approval provision and much else is, for me, really the book's principal contribution. All of this said, the concerns about moral hazard and reducing the risk of taxpayer losses that help drive the Dodd-Frank restrictions are obviously not frivolous. Professor Scott, I think, does not deny that the enhanced capital standards, liquidity requirements, orderly liquidation authority, and other actions that have been taken to reduce the likelihood of another crisis in the near term and its severity if it occurs may prove beneficial, although I'm arguing, and I think you already have argued with some of the details. But the book argues persuasively, and this is the key point, and you've already made it, that none of these reforms, individually nor all of them collectively, are sufficient to prevent a run or to stop one once it starts. There is one other point I need to make here, almost on a personal note. For many years, led by my colleagues Marvin Goodfriend and Jeff Lacker, the Richmond Fed has warned of the dangers of Fed policies or actions that involve it in credit allocation. This is what Marvin, my longtime colleague and a good friend, refers to as credit policy as distinct from monetary policy. I share this concern, and I have to confess, that I've generally thought about it in a macro monetary policy context rather than in the context of the Fed's lender of last resort role. Scott's book challenges me by demonstrating convincingly that the financial crisis was largely an old-fashioned run in a new costume, and forcing me to ask myself whether it would be feasible in dealing with a similar future crisis to avoid some credit policy risk. I need to think about this, but you certainly have me thinking and asking the fundamental questions here. I feel compelled to offer at least one nitpick, if I may. I guess I really feel like I have to do that. I found the reasoning in a few sections a little on the tense side. One section in Chapter 21 discusses the possibility that the Fed's current reverse repo program might be used to or result in some way a crowding out of a significant portion of the economy's short-term private credit liabilities. And then it goes on to consider, and this is where I got into trouble, how such a development might conflict with the Fed's basic monetary policy objectives. I got really confused. I will tell you that I was on an Amtrak train south of Washington behind a freight train when I read that section, so maybe that had something to do with it. But I do think that section and one or two others could be simplified a little bit and clarified. I've probably said enough by now to signal my high regard for this book. I can do it. I can do it. But in closing, let me salute an issue that the very strength of the book, for me, actually highlights. If the Fed and the FDIC need strong and essentially discretionary emergency powers to prevent or confront runs, how do we reconcile such powers with the legitimacy requirements of a democratic society? This is obviously a critical question in today's political environment with its highly populist elements. The Dodd-Frank requirement of Treasury Secretary approval that we've discussed of loans to non-banks, and importantly, the accompanying requirement that the Secretary consult with the elected president in making such decisions is presumably a recognition of this issue, although we have seen, I would argue, a problematic one. Resolving this fundamental tension in our political economy, if that's possible at all, is beyond the scope of this particular book, although there's no question that Hal is well aware of the issue. I do believe that some of the contributions of Paul Tucker, the former deputy governor of the Bank of England, regarding the legitimacy of central bank independence, not only in the emergency lending arena, but also in the monetary policy arena, looking at them as a sort of regime, taking them together. Some of his work, I haven't finished it all yet, but from what I've seen, I think that's a good place to start thinking more about these issues. Thank you very much.
Thank you. Pete?
This is a really interesting book. He's got Hal Scott's got 3 C's. One of them is called Connectedness. Finance professors and macroeconomists often use the term fragility to describe what he's talking about with connectedness or networks. There have been a huge amount of research by young finance professors on network theory and the application of networks to finance. And Hal Scott comes along and tells us, a lot of this research is pretty useless or is not really relevant to explaining what happened during the financial crisis for some good reasons I'll talk about in a minute. You've got the second C that's not in the title of the book. The title of the book is Connectedness and Contagion. The second C is what Hal Scott calls a correlation. I like to think of correlation as capital, and it's associated with deleveraging. So a big shock, in this case it was the decline in real estate prices, hits the economy. And it turns out that the real estate assets that are affected, a lot of them are in the banking system. They're mortgage loans of various types. And it turns out that loan-to-value ratios were very high, and it turns out that lending standards had been relaxed. So the result was that when housing prices fell, many banks simultaneously or in a correlated manner suffered hits to their capital. And there's a lot of macroeconomic and finance research that says that when that happens, these financial institutions are going to deleverage. And that the reason they have to deleverage is that they were holding these mortgages with leverage. Their capital is leveraged 10 to 1 or 20 to 1 or whatever the ratio is that the regulators allow them to hold it. And then there's the third C, that's in the title, Contagion. And contagion is what I call panic, and I think what David Ricardo calls panic, and what a lot of other people also would call panic. Now, Hal Scott's book gives us a different view on the financial crisis and its relationship to the Dodd-Frank Act than the view that I've had before I read the book. So let me tell you the view I had before I had read the book, and then the way in which it changed my view. The way I used to summarize the Dodd-Frank Act is to think of there had been a big capital hole in the financial system as a result of declining real estate prices, and the problem that needed to be fixed was that banks needed more capital, and the sooner they got it and the more capital they got, the more rapidly the financial system would recover. And my summary of the Dodd-Frank Act was that while the Dodd-Frank Act did encourage policies to make banks have more capital, mainly what it did is impose a lot of regulations on the financial system, so that the authors of the Dodd-Frank Act faced a trade-off between simply mandating more capital and mandating more regulation, and they chose to mandate more regulation than to mandate more capital. But Hal Scott's book has changed my view on that, and as he points out, if you have a capital problem, or even if you don't have a capital problem, you can have a panic. But Charles Goodhart and David Ricardo and other people are going to tell you that if you do have a capital problem and it keeps getting worse, before the financial institutions collapse or declare bankruptcy from lack of capital, people are going to try to pull their money out. And when that happens, you're going to have a panic, and the panic is not only going to hit the bank that maybe was truly undercapitalized and on the verge of insolvency, but that panic is going to hit all the other banks in the system, regardless of whether they're well capitalized or not. It's going to be indiscriminate, and it's going to create a crisis. And the crisis requires immediate response. And the immediate response that's necessary to fight this contagion or this panic is lender of last resort facility or other credit support facilities, and they pretty much have to be provided by the Fed. And so Hal Scott's book comes in and says, if you look at the Dodd-Frank Act, what you're going to find, it's not just imposing regulations on regulations for regulation's sake, but there's a misguided theory behind it. And the misguided theory behind it is that the Fed's lender of last resort facility needs to be curtailed, and it needs to be harder for the Fed to provide liquidity support to financial institutions that may well need to be recapitalized, but in the meantime, you've got a panic going on, and you need to address that panic with some very strong immediate action. So he spells out this scenario in great detail, and it's changed the way I think about the financial crisis, and it does make me worry whether our Fed has the tools that it will need to fight the next financial crisis, especially if, might well happen, the next financial crisis originates outside of the banking system that the Fed is itself is most capable of making lender of last resort loans to. So that's a big picture. But there's some very interesting chapters in the book that describe the more details about what I just said. So let me mention a few of them. First of all, in talking about connectedness, he paints a beautiful picture of Lehman Brothers. And Lehman Brothers itself is an incredibly fragile institution. There are huge, important connections between the holding company and the subsidiaries and cross guarantees and so forth. And the result of that is that if problems start within Lehman Brothers, there is a connectedness problem. These problems are going to spread throughout Lehman Brothers. And so Lehman Brothers itself, as he paints in a very detailed picture, Lehman Brothers itself collapsed in a very connected way. But the sense in which he's saying that connectedness was not so important for the financial crisis is that when you look to see how the financial crisis spread from Lehman Brothers to the rest of the economy, it didn't spread through connections. It didn't spread through Lehman was defaulting to Goldman Sachs, and then Goldman Sachs defaulted to the next one defaulted to the next one, and the economy blew up that way. Instead, Lehman Brothers just kind of collapsed rather neatly through its own internal fragility, but it didn't spread to the rest of the system through these connections. It spread to the rest of the system through panic. So the reserve fund held some Lehman assets. Those Lehman assets declined in value. The investors in that particular money market fund lost some money. So what happened? The investors who invested in the other money market funds panicked, pull their money out of those funds, even though those funds maybe didn't invest in Lehman assets at all. So he paints a very interesting picture of how fragile Lehman was within itself, and also how that fragility was not what made things spread to the rest of the financial system. Indeed, if you look at the collapse of Bear Stearns, which had happened months before, Bear Stearns collapsed in a way that was kind of similar to Lehman, and you didn't have the panic at that time. The panic waited until it could occur later. So interesting thoughts about connectedness. Let me also talk about correlation, or what I like to call capital. I think that the financial crisis of 2008 was largely a problem of capital. And the book has some interesting chapters on contingent capital as a way, or COCOs as they're called, as a way to deal with this. It also has chapters on orderly resolution and...
Capital has 1 minute left.
One minute left. And orderly resolution and other ways of kind of bailouts and TARP and how that happened. But I'll end my comments with just one note about contingent capital. It's the one area where I slightly disagree with the book. Contingent capital doesn't need to be a long-term liability of the bank. It can be short-term. The key feature of contingent capital is that it has to be replaced. That if the bank's got, let's say, 1 year maturity contingent capital and it matures, but the bank can't replace it with new contingent capital, then right then and there, that contingent capital is not being replaced, is going to get converted into equity. So it doesn't have to be long term. And the second thing about it that I slightly disagreed with was he says that one trigger mechanism for contingent capital, which is securities that will convert into equity when the bank gets into trouble, is that one conversion proposal is to look at an index of bank stocks. And if the whole index of bank stocks declines, then contingent capital gets converted. Hal Scott's book says that if that happens, that could kind of amplify panic. And I think that's not quite right, because one interesting thing about contingent capital, if panic makes the contingent capital investors not roll over their capital so that it converts, all of a sudden there's this massive inflow of new equity that the banking system has just gotten from the conversion of the contingent capital, and I think that's going to stop panics, not make them worse. So various mechanisms for recapitalizing are something we should think about, and we should certainly think about, worry about the ability of the Fed to exercise the powers that it needs to act as a lender of last resort next time a financial crisis occurs.
Thank you, Pete. Paul.
In his new book, Connectedness and Contagion, Al Scott reminds us that historically, the first and most important function of a central bank is the provision of lender of last resort liquidity to stem financial crisis. Lender of last resort, or LLR for short, was the reason that most central banks were originally created. And yet Dodd-Frank comes along and it sort of cuts off the Federal Reserve's ability to effectively do lender of last resort lending for much of the economy. I'm going to focus my remarks on lender of last resort. In his book, Hal does a superb job of distinguishing between connectedness and contagion. All large financial institutions are connected. There's really no surprise there. But contagion is a property whereby the well-being of one firm can impact the well-being of many separate firms that are not necessarily connected to the firm in question. For example, the Reserve Primary Fund breaks the buck, and soon other institution-only money funds without exposure to either the Reserve Primary Fund or Lehman Brothers need liquidity assistance from their parents to meet redemptions. The classic example of contagion, a run on one bank creates a general panic and depositors run healthy, unconnected banks. The Federal Reserve's wide-ranging use of LLR powers in the recent financial crisis has been unfavorably portrayed as a taxpayer bailout of the financial sector. As a consequence, the Dodd-Frank Act placed new limits on these Federal Reserve powers. The LLR is a complex issue. The emergency provision of liquidity probably will always have the appearance of a special privilege for a few select firms, and in a real sense it is. LLR protects financial firms from suffering fire sale losses and in some instances from outright default. The justification, of course, for LLR is that the run forces financial firms to undertake fire sales which affect other firms, and while the runs may be rational for short-term creditors, they are not always justified by economic fundamentals. LLR is based on the idea that everybody can be made better off if the government can prevent panic redemptions. But the Fed's LLR policies were discretionary, so it could be used to save firms with unsound fundamentals that should be allowed to fail. The rub, of course, is in the midst of a run, you can't tell the difference between a firm that deserves liquidity support and one that isn't. And the judgment call can always be open to criticism. Why save Bear Stearns and let Lehman fail and then save AIG the next week? So this discretionary policy created a lot of problems. And if you think about it, the need for LLR is somewhat ironic given regulatory rhetoric. Financial regulators are quick to highlight the disciplining effects of market forces. While almost never described as such, a bank run is perhaps the most fundamental of all market discipline forces. Many scholarly papers are written to explain how banks' fragile business model, borrowing short and investing long-term in opaque loans, is a market innovation, not a mistake. It's before government safety nets. Investors required banks to fund themselves using short-term liabilities and demandable deposits, precisely because this fragility imposed discipline on the bank's investment decisions. A banker with inadequate liquidity was unlikely to be a successful banker, at least not for very long. And so while regulators espouse the enthusiasm for market discipline, they simultaneously argue that they need lots of tools and discretions to prevent bank runs and fire sales. Hal Scott rightly suggests that post-crisis politics are stacked against new discretionary Fed lender of last resort powers. However, I think the political sticking point may be not lender of last resort so much as the free and discretionary nature of the prior Fed LLR arrangements. The Congress and the Federal Reserve, in my opinion, should work together to develop a new approach for lender of last resort that relies on a market where institutions pay the taxpayers to purchase liquidity insurance coverage before it's needed. Indeed, Hal discusses such a proposal in his book, but I want to go a little bit farther in the next few minutes I have. The Federal Reserve should be required to sell liquidity options. Now, liquidity options are options that once a firm owns can be presented to the Federal Reserve and exercised as long as they have appropriate collateral and they would receive a loan from the Fed. I believe the Fed should sell two kinds of liquidity options. One that allows for the term exchange of collateral, i.e. I bring bank loans to the Fed and I get Treasury bills in return, and one that allows acceptable specified collateral to be exchanged for reserve or balances for a fixed term. So there's a securities lending liquidity option and a repo kind of lending option. The instrument, I believe, should be sold at regular Fed auctions, and they should be traded in secondary market thereafter. The option should have specified exchange terms, haircuts, and implicit rates that are less generous than those prevailing in the private security and lending and repo markets. The price of these liquidity options would reflect the shadow price of emergency liquidity. If bank liquidity coverage ratios and net stable funding ratios, these new rules we put on systemically important financial institutions, if they were amended to allow liquidity options to satisfy this requirement, we could create a natural market for these options. Banks would buy them. This arrangement would drastically improve the risk sharing in the economy over the current self-insurance approach for liquidity insurance, which Hal mentioned. If we did something like this with a market terms, emergency liquidity access would no longer be a special privilege, but merely the exercise of liquidity insurance on previously agreed upon terms and terms that firms paid for the right to exercise liquidity option. The purchase of these liquidity options and their use should be open to all financial institutions, not just depositories. So non-banks as well should have access. If a liquidity crisis were subsequently to develop, the terms of the liquidity insurance contracts could be adjusted and to allow the Fed to provide all the emergency liquidity the economy needed. So they could lower the rate over the market rate, change the collateral terms. They could adapt the options and still sell them and meet the liquidity demands of the economy. This approach would remove the need for the Federal Reserve to determine whether or not an institution is solvent to seek liquidity support. If they have the option and they have the collateral, the Fed would honor the contract. And taxpayer losses could be prevented by setting appropriate haircuts and granting the Federal Reserve priority on any borrowing institutions that subsequently entered bankruptcy and imposed losses on the Fed. I think a market-based solution to some of these problems would stem a lot of the issues, LLR issues. And Hal brings up this and talks about a proposal in his book, and I would like to see folks take that up in a little more detail, because I think it solves many of the problems that we discuss in the book. I think the book discusses a very, very important issue, and it gives us a lot of food for thought about the right way forward. LLR in particular, I find to be the most distressing problems created by Dodd-Frank. And thank you very much.
Thank you, Paul, and thank you to all the commenters. Well, Hal, we're going to give Hal some time to respond in any way he likes to those comments. While he's thinking, Al mentioned musical chairs, and when challenged after the crisis to come up with a metaphor for a panic, musical chairs is a natural one, and I invented this one. Imagine a game of musical chairs that has 500. For a financial system, you got to have a lot of. One of the problems is there are a lot of actors. So you got 500 people playing musical chairs, but there's 700 chairs. And the music that's playing is a charming Mozart serenade. And when it stops, everybody easily finds a chair. We call that high liquidity. Suddenly, the music shifts to raucous, obnoxious, popular music, and 400 chairs are removed, leaving 500 players and 300 chairs. And I think that's a great picture of what happens in the panic. Hal, comments on the comments.
Yes. So, Al, you ended with the reference to Paul Tucker and the legitimacy of central bank independence, which I think underlies a lot of this discussion. To me, I remember an AEI person, Peter Walson, and I discussed co-authoring a piece on contagion along the lines I developed. And Peter said to me, well, I don't have any problem with that, but it's all the rest of the powers that the Fed's exercising over supervision and regulation. So if you're critical of that, I'll join you on the contagion. But what I guess I would say is that I think the Fed, the central bank independence of the Fed, is being more undermined, in my view, by all these other powers that they're exercising through regulation and supervision, maybe than being lender of last resort. It's a bigger picture. On contingent capital, I'm willing to think more. I guess my central point is that I wouldn't think that having a good system of contingent capital says to abolish the fire department. I don't think you would say that. So my central point on resolution is, even if it works, we still need to worry about contagion. Imagine Jamie Dimon calling up Secretary Lew and saying, oh, heads up, we're going to bankruptcy tomorrow. Is the response of the secretary, oh, no problem, we've got resolution procedures? Well, I don't think so. The first thing he's going to think about is the proverbial S hitting the fan in total panic, in the world's financial system. You need to be prepared for that. In terms of Paul, as Paul pointed out, I did actually hold out this idea going back to Y2K. It was actually Peter Fisher who, when he was undersecretary, created this kind of procedure in advance of Y2K, so it would be very clear to the market, that people have liquidity. It's interesting because that idea runs in the face of 25 years ago when the Fed would talk about systemic risk, ambiguity. We needed ambiguity about whether the Fed was going to lend. And Jerry Corrigan was really big on that. And CHIPS and the payment system, which was the earlier manifestation of systemic risk. And I think your point fundamentally says, no, just the opposite, We need to know in advance. The beauty of lender of last resort, if it's strong, however it's engineered, by options or otherwise, is if you know it exists, you're not going to have the problem. That's when Draghi says, I do what it takes, and nobody uses his facility, Because as long as the power is there, people aren't going to run. It's when you have ambiguity and people are uncertain as to what's going to happen is that they're going to do it. I guess the other thing I would say about, and I haven't thought through this, about the proposal, which I think is very worth exploring, is, if you don't require people to have these options, then what happens, you go into a situation, Lehman doesn't have the option. So Lehman fails. Now, what you can say is that everybody else who's got that option, if they're run on, they got a way to protect themselves. But I think you have to have a critical mass of acceptance of the options and the obtaining of these options in order to solve the problem. So, Paul might want to.
Yeah, so the idea that you change the liquidity coverage ratio and the net stable funding ratio rules to allow the use of options in replacing actual instruments means the banks will have some, and you have a secondary market, so if Lehman didn't buy any, they could buy them from the banks that don't need them. And when you observe the secondary market price, the liquidity option going up, the Fed has the right to step in and open up the auction, sell more. You have a monitoring vice in the secondary market. So you would expect dealer banks to purchase, or dealer financial institutions to purchase and stockpile these liquidity options and sell them to people when they needed them. And they charge for them, sure. And you'd know the price and you'd see the demand for liquidity. I think you would have, the Fed wouldn't be caught flat-footed like it was in the summer when the commercial paper market blew up and they were wondering what was going on. You would see it on Bloomberg, the market price of liquidity skyrocket, and they couldn't deny there's a liquidity problem. And they'd sell more options and make adjustments. So I think
with that provocative thought, and we could have a lot of fun talking to each other, I do want to fit in one or two questions. Paul, I would just say, of course, the Fed could lend Lehman money so it could buy options from Morgan. Kidding. We have time for one or two questions. We have one in the back here.
Andrew Qualley, I'm a lawyer.
Wait, I'm sorry. Will you wait for the microphone to come to you, please? Thank you.
Andrew Qualley, I'm a lawyer in New York. Hi, Scott. I hate to say this about a Harvard Law School professor, but I think this is terrific. And I went to Harvard Law School, so it's excellent. I've had the same issues and same concerns during this whole Dodd-Frank development. Part of Dodd-Frank is fine, capital enhancement, trying to eliminate incentives, bad incentives, moral hazard, not very successful there. But the key thing I think that you've focused on is tying the hands of the Fed and the Treasury. I think they really are very wrapped up, and this is made worse by the AIG case, where the Fed has said that they didn't have 13.3 authority in the case of lending to AIG and taking back stock. That was considered not to be a security interest or collateralized by the judge. Judge is totally wrong, but if you are an executive at
I'm sorry, you'll have to come to a question if you have one.
Here's my question. Why does the Fed, my friends at the Fed also think that Section 13.3 as amended does not tie their hands very much? I think it's wishful thinking. I don't understand this, and I think also the resolution authority is totally useless. When Citi goes down, they don't have time to resolve it. So I'd also agree with you heavily.
I think that's a question to you, Hal. Why would the Fed think that it...
Well, I don't think they do think that. If I were at the Fed, I would be saying what the Fed is saying. We don't have a problem here.
Yeah.
Well, do we want to undermine confidence in our own institution? No. I can tell you from my private conversations, okay, I think the Fed is extremely concerned about this. And the first Fed official who raises his hand publicly and says, we need to do something about Professor Scott's book. Oh, you want to bail out Wall Street again. This is toxic.
It's going to take time.
They're going to take a lot of time.
Okay.
I think we have come to our adjournment time. However, I want to give any member of the panel one more minute if you have a parting thought.
I guess I'm very intrigued by Paul's proposal. I think it's worthy of some additional thought and investigation. One thing, in dealing with the crisis, an issue that Bernanke thinks is one of the most difficult to deal with was stigma, getting banks to borrow. Well, this is going, if it's based on
Right.
auctions, it's good. That would be one benefit of it. You know, you get around that problem. That's why they had to start the auction procedure to begin with. So that way it would be built in right up front.
I would just one thing about Paul's. I think if the Fed proposed that, you want to give them advance protection. You want to give them a promise to bail them out.
I've been out of the Fed for 12 years.
No,
so
I mean, within the political system today, I think that
I think
would be a problem.
I agree, and as both of us are occasionally on the Hill and testify, I completely agree. I think you sell people on the fact that they're paying for the right to have protection. They're paying the taxpayers for this, and it's not free any longer.
Yeah.
I agree there are political issues, but I think we can get around them. Maybe.
Okay.
I think we got the sense of the panel, Hal, that you have raised serious and deep problems in the book which need addressing, and we thank you very much for coming to present it. Thank you very much to the members of the panel. If you have more questions, we'll all be at the reception, and just ask us in the informal setting. And with that, thanks to the panel.